All right. Okay. Evening, guys. Apologies. Technical issues here. Completely forgot that I was supposed to switch over my streaming software. I didn't quite know when it was going to happen, but I knew it was going to happen, and it just so happened that I had to have switched it over today. And the new one that I was going to use has got issues. So apologies for the tardiness in terms of getting on here. But anyway, so I wanted to do this today purely because tomorrow I'm in London overnight. I've got early meetings in London on Monday, and then we're filming 2 days in Cardiff. So literally to be able to do this Q&A, the only time to be able to do that would be today. So hence why we're doing it on Saturday in opposed to Sunday. Next week we should be back to normal programming. But yeah, I know that there are a few people on here already. Evening, Trevor, how you doing? CEO, how you doing? We'll just talk about what's going on at the moment. Obviously, markets and all that are very interesting right now. It's one of those scenarios that obviously uncertainty is a big deal. By the way, if you are not in my Discord group, there will be a link pinned, or actually in the description to this. Through this week, I kind of gave a little bit of an update around what the markets were basically doing. Obviously, gold, commodities, silver, platinum, they were all up this week, quite significantly actually. And we saw crude oil hit 8-year all-time highs, and that's to be expected when you look at what's going on at the moment with the markets, and just look at the Ukraine-Russia situation. In times of war, gold tends to do pretty well, and so it's no surprise that we're seeing a bit of a flock towards gold at the moment. If you watch the video on Tuesday, I kind of give you guys 3 ETFs as potential options for you to access some gold with. Obviously, that's not the only way to access gold, so it's really, really important that you do your own research around how you want to access gold. Some people prefer to have physical gold being held, which is always a good thing. Only problem with that is obviously storage, and obviously you're going to have broker fees and all that kind of stuff. It's not as liquid, it's not as easy. If you go and buy an ETF, for example, you can just literally just buy the ETF, sell it as long as the market is open. It's pretty quick. But yeah, you can use apps that will allow you to buy gold. There's all kinds of ways for you to basically buy gold. But I gave 3 examples of an ETF which you could use to basically access some gold. The markets this week have been interesting. Globally, everything is down. I think globally, everything is going to be down for a very, very long time, or at least whilst this conflict is going on. I've been doing a bit of reading today and looking at some commentary from the likes of people like BlackRock and so on and so forth. And there was an interesting article, actually. One was saying that now is not the right time to buy the dip, that people should pretty much do nothing right now. They shouldn't sell. They shouldn't be buying. They should just be holding on their portfolios. I don't know whether... Do I agree with that? I do to a certain extent. I think if you're buying the dip right now, certain companies, I hope that you're buying in the right sectors and you know what you're doing. The full impact of what's going to transpire as a result of Ukraine and Russia, we can't gauge that just yet. We really, really can't. And because obviously the invasion came at such a surprise, all of this was not priced into the market for us to be able to, say that it's accounted for. It's not. And, Russia, if you look at the industries that they supply, steel, massive provider in the steel. So there's going to be a knock-on effect into the automotive industry. They already have issues when it comes to chip shortages. So that's a double whammy potentially for them. We all know what's going to happen with oil prices. Those are going to be soaring. That's going to impact our inflation locally. I think the companies that will tend to do well will be the ones that have the ability to pass on that increased cost to their customers, which is a double-edged sword, because ultimately, if you're a consumer or a customer of these companies, you're going to feel the pinch. But if you're a shareholder, you're probably going to not feel the pitch, because you should see the profitability and therefore the share price also increase. So it is a double-edged sword, if you will. So it's an interesting time right now. I'm not doing anything. I'm not selling. I've a lot of the stuff that I've already sold, I sold very, very early on in the year before any of this happened. So I'm holding my position right now. And I just wanted to, just say to you guys, obviously it's your money. I'm not your dad. I'm not your uncle. You got to do your own research, make sure that you're happy with the decisions that you make. But if people are, you know, looking at the dip and going on this YouTube mantra of buying the dip, I hope you know what you're doing. I really, really do. I really do hope you know what you're doing. Um, Things could get very, very ugly from here on out, especially when we get round to March 16th and we start seeing whatever interest rate hikes the Fed is going to bring along, which I'm so interested to see what the interest rate hikes are going to be. Number one, how quick are they going to be? How much by? And whether they're going to increase the number of interest rate rises in order to combat inflation at the rates that they're going to be once everything around Russia's already factored in. I was reading this week that the impact of Russia is likely to impact in inflation numbers by 3%. That is a lot. And think of it this way: inflation's already high before all of this stuff kicked off. So the markets at the moment are in a very, 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 very interesting place. They really, really are. And so I think it's just about being patient, holding nerves, and just believing in what you're doing at the moment. So let's have a look here. Are we in stagflation? I don't think so. Not at all. I think we're going to start seeing this stuff increase even further. We might even, but I don't think we'll be in the territory of hyperinflation. Russia's definitely in that. Or are they in that environment right now? I mean, the Russian stock exchange has been closed all week for the first time in, I think, their history, because they fear a run on the money on the markets because of the sanctions that the West have imposed, with obviously the SWIFT bans and all this kind of stuff, right? And as we see more businesses exit out of Russia in protest against what's happening right now, they're scared for their stock market. Now, when you look at their stock market, can it have a systemic impact on global markets? Absolutely not. It's tiny. But they've closed down their stock market for the entire week because they are a little worried about what could happen once the markets open. And trust me, the markets will be open. It's almost staving off the worst, because when the markets do open, there will be people who want to massively sell down their portfolios of any Russian stocks. Gazprom, companies like that, I mean, their share price are going to fall massively, massively. And you then start thinking about the fact that this week they took their interest rate from 9% to 20%. I mean, we're quabbling over 0.25% here and there here in the UK, with these interest rate hikes going in over a 12 to maybe 16, 18-month period. They did in one fell swoop 9 to 20%, over doubling their interest rate, purely because they were fearful of a run on their banks. Everyone will remember, or maybe not remember, 2007, 2008, Northern Rock, queues around the corner, people trying to get their money. That's what they're worried about. They had queues. They had to limit people on the amount that they could draw from the banks, because the cash physically wasn't there to give everyone their cash. And so one of the ways that you can kind of counteract that is to say, guys, okay, you know what? We're going to give you a better interest rate. So you had 9, we're going to give you 20 if you keep the money in there. These are all very, very desperate measures. Not really had much of an impact from a global point of view, but still very, very, very bold, and I guess necessary moves based on where they are currently. So yeah, it is what it's very, very interesting right now. But like I said, you guys got to do your own research. Please don't take anything of what I say as financial advice. Your capital's at risk, obviously, so you just need to make sure that you're comfortable with all of this. Let's have a look. Is 60-40 portfolio strategy history? No, I don't think it is. You're still going to use that You need to understand the methodology behind the 60/40 um, portfolio makeup. It's not done just for based on markets and what markets are doing. No, it's an investment strategy. So it adapts and it's suitable for all manner of market um, circumstances and situations. It's not done as a means for growth. It's a systematic strategy to invest in the stock market, which will have strategic and tactical asset allocation protocols underneath it as well. I might draw this out for you a little bit later on just to want to explain how this actually works. But this really does lead us on to the conversation around active versus passive investments, and looking at that really as a for the merit that it basically provides. The question is, if you are picking your own stocks, do you really understand what you're doing? If you're buying your own stocks, do you understand what you're doing? Do you understand decisions that you're making right now? Do you have access to reliable information? You may not. But right now, research and having information that you're able to decipher is so important. It's absolutely key. So I don't think 60/40 is gone. No, absolutely not. 60% equities, 40% in bonds. The bonds are there for times like this when equities are a little bit, all over the place. They're there to give you security. When I talk about gold this week, people talk about, buying gold at an expensive price point. You're completely missing the point. The point of having something like gold as a diversifier in your portfolio isn't so that you can make money on it. It's so that the money that you put into it actually holds the value. That's what it's all about. Against the backdrop of a volatile falling market, it's about holding an asset that is going to, at the very, very least, hold value. It's not about making profits in times of volatility. Where do you want your money? Do you want to, analogy that I might use here is, you've got to go to the river, right? And you've got two buckets. You've got a bucket with holes in it. You've got a bucket with no holes in it, right? It's kind of like that, right? You want something that's going to hold the value of your money that you put into that asset, and that's the whole purpose of a diversifier. It's so that you can put an element of your cash in there. It protects you to a certain extent or to the best of its ability based on circumstances to ensure that you don't suffer undue losses. That's what it's all about. So 60/40 is all about managing risk. It's a strategy to help you get the best out of your performance or the performance of a portfolio based on the circumstances in the market, whatever circumstances come along. Because when we build those kind of strategies, the key things that are being looked at are volatility. What are the client outcomes, objectives? How long are they looking to invest for? Those are the key fundamental foundations behind all of these decisions, essentially. Then, like I said, it will have tactical and strategic asset allocation protocols underneath that, which will mean that the portfolio can flex if it needs to. Yeah, dude. So look, listen, I've got a really, really busy week next week. And so I'm going to be in London literally tomorrow night. And so I thought I'd do this tonight in opposed to tomorrow night. Because just keeping up with the schedule essentially. So I don't know. The numbers on here are good, which I don't think that they are going to be. It's Saturday night after all. People want to go out and live their lives and stuff. But if the numbers were good, then I would potentially make it more of a regular thing, and maybe stream on a Saturday. But looking at the numbers just yet, I don't think it might be worth it. But we'll see. We'll see. Right, let's have a look. Joshua, how you doing, mate? What's this about Transport for London? Increased coverage of the youth zones in the City of London. Plans £12.50 vehicle charge. Yeah, I mean, when I drive into London, I drive a Tesla, so I don't pay any congestion charges or anything like that. So, and I park pretty cheap in the centre of London in Westminster, so it doesn't really impact me. And that's one of the great things that my car kind of has as a benefit, really, to be honest. It's definitely saved me a ton of money in fuel and congestion charges and stuff. Would you recommend joining the market once the war in Ukraine comes towards its end? Well, the problem there is, Josh, when is it going to come to an end? You know, again, this is one of those situations where time in the market, you can't time the market. It's impossible to do. You're either in, or you're out. And the thing that is the most important aspect of this is accepting that there is risk when you go into it. That's just the reality of it. You know, just because there's war doesn't mean that there won't be opportunities out there. There will be opportunities out there. It's a case of, if you want to do it yourself, can you identify what those opportunities are? Do you have the skill set to be able to select the right companies or a group of companies based on solid research or intel or whatever? And if you're not going to be in the boat where you're going to be picking your own stocks, are you using a provider that has the ability to do so? People like, Wealthify, for example, people like that, having structure, teams, research behind them to help people take the burden of all of the thinking and the research and the worry sometimes off your back to be able to do it for you. We don't, this war could go on for 10 years. So what are you going to do? Do nothing for 10 years? You've got to be in it to win it. And being in it to win it means taking the good with the bad. And at the moment, it feels as though there's going to be a bit of bad in the markets for the next, I don't know, foreseeable future, for however long this basically lasts. But if you're looking at some of the news, it's what they're doing out there is it's absolutely it's bonkers. It's crazy. I mean, shelling a nuclear facility. I mean, it just blows my mind. And I don't know whether it's being done to send a message to the West, like, don't get involved here, don't mess with our resolve here, but it's just lunacy. It's absolute lunacy. They know what they're doing. And with that in mind, this could go anyway. We have no idea where this is going to go. I think, the smart people in the room don't want to escalate, and rightly so. But at the same time, it's like, well, if you give over to a bully, what does a bully do? He continues to bully, you know? So, and this isn't going to be the correct analogy, but I look back on, if you've ever been in a school where you've been bullied as a kid, and I was bullied as a kid growing up in, the 80s, the only black kid in the school, I was bullied big time. It only stopped when I actually stood up to the bully. This is bigger stakes right here, but the underlying, I guess, argument still stands. If you let him get away with this kind of stuff, he'll just carry on and carry on and carry on and carry on. And where's the stop point? That's the hardest thing right now. Just watching it is horrific, but it could go on for a while, and you can't let it dictate your choices in terms of what you need to achieve for your life. Because if you wait this out, you could be waiting 5 years. The market could do modest returns over that period of time that you haven't participated in. So you've got to take the good with the bad, mate. If you're going to get in, just know that it's going to be a really, really bumpy ride. It's weird because I'm watching, I do keep tabs on a load of channels here on YouTube that do a lot of, different kinds of content around investing and buy this stock and buy that stock and buy this. And one of them now is like, don't invest, no investing for 2022. And it's like, well, a couple of months ago, you were telling someone to do this, do that. And it's all very well saying, you're commenting on what's going on at the time. But where's the consistency? How do you give people confidence? People may be worried about their portfolios, and rightly so. If this escalates, rightly so, they should be worried about their portfolios. But the fundamentals of just accepting that it's going to be the way it is, we can't do anything about it, is fundamental. Musk brothers, particularly Tim Musk, sale of Tesla shares before Elon tweets. Any thoughts? No thoughts on that at all, mate. I mean, what they're going to say? It's insider trading. Prove it. Prove that it's insider trading. The choice to sell shares, what? Because he's Elon's brother. you can't substantiate whether they had a conversation about the shares or not. When did he sell these shares? What happened to the share price after he sold the shares? What's happened to the share price since? You know, I think a lot of this stuff is just a lot of just hogwash, really, to be honest. You can't substantiate, you can't prove it. If you think about if Tesla share price was at an all-time high at that point, he sold it and it's crashed and it's gone to the floor, right? And there's no kind of like history or forecast to see that actually the fundamentals of the business are good. You can't say because, he's Elon's brother, you can't sell his shares and coincidentally the share price falls, and therefore, there's got to be something dodgy going on. I think it's absolute nonsense. But I don't. Yeah, those are my thoughts on it. I just think you can't really pay attention to that kind of stuff. I mean, Tesla always has. There's always some kind of bad press about Tesla around something going wrong, like or some kind of scandal, and it's like it's headlines basically because Tesla's what the hottest EV manufacturer on the planet right now. With everything that's happened with Russia, right? It even highlights even more why we need to move towards sustainable and energy sources and move towards electric vehicles because Germany being depending on Russia for 40% of their energy supplies is lunacy. You've got a gun to your head and you can't take action because you have a gun to your head. So you have to. They're looking at this at the moment, weaning themselves off energy supplies from Russia. But even we're going to feel this. We've got 3 or 4% energy supplies coming from Russia. Had we invested in renewable energies at a faster place than we have so far, you could say with hindsight that we would be in a much, much better place. Energy prices wouldn't be soaring. I mean, energy prices are going to get even more expensive now that it's kicked off. People already feeling the squeeze. We're going to feel the squeeze even more just because of what's happened now, because we haven't made the right choices. And it's, headlines. Newspapers sell headlines. That's what it's all about. But there's no way they can substantiate and even speculate that that's insider trading. Absolutely not. They wouldn't say anything if he sold it and the share price went up the following day. What would they say? Oh, well, you need to invest it. You investigate. He lost out on millions. No, of course not. Tamas. When it comes to buying a property, the 4.5 times salary deal applies to your salary, to mortgage amount that you borrow, or does that apply for the salary? Okay, so right, let me see if I can illustrate this. 1 second. Hopefully this will work. This should work. Be good to me. Yes, it does work. All right, okay. So. Where are we going? Let's get a new one of these up. Let's expand that. Oh, crap. 1 sec. What have I just done? What have I just done? There we go. That's better. All right, okay. Let me just share my screen and I can illustrate what I mean, what I'm talking about here. We want not that window, we want this window right here. Okay, cool. So you should be able to see that now. Right, so 4 times salary, how does it actually work? Let me just decide on what numbers I want to use here as well. What's going on with this? Don't be temperamental with me. There we go, that's better. Let me just get rid of the question really quickly so you can see the full screen. Okay, so 4.5 times salary. So let's just say you want to buy a house. 1 second, guys. What's this thing doing? Okay, it's back now. Let's try this again one more time. If it doesn't work, apologies. Right, so let's just say you wanted to buy a house and this house is worth £500,000, okay? Now, let's just say that you had an income of, I'm going to call it £50,000 per annum, yeah? Your 4.5 times is on your salary. So in this example, you're looking at the amount you could borrow being 225,000 pounds is the maximum that you will be able to borrow based on this income. Okay, that's how it works in theory. Now, obviously, there's a big difference between the 225 and the 500,000 pounds here. So this is where your deposit amounts basically become really, really important, because you need to basically find the difference of the deposit of the difference between the amount you could borrow and the deposit amount, which is 275k. You need to have that as a deposit in order to be able to buy a house of that value. Now, very, very simply, if you're looking at 50k, then you're probably looking in the region of about 250, something like that. But you probably need something like a 25 grand deposit. That would make sense. That would make the numbers make sense, right? So if this was instead worth 250, yeah, you would only need a deposit of, say, 10%, which would be, in this example, 25k. So by the time you mix that with that, you've got to that amount right there. That's how it works, essentially, in terms of the multiple of your salary for mortgage purposes. Now, I know that for a lot of people, the whole 4.5 times, because this is the big problem we face here in the UK, right? It's the fact that, unfortunately, if you look at wages, they've not kept up with inflation in any way, shape, or form, and they've definitely not kept up with house prices either. So as these two things have soared in value, this has actually either gone down or remained stagnant. So you've got a really unbalanced equation between people being able to afford a house and actually earning enough money to be able to get them on that property ladder in the first place. Now, probably a couple of months ago, I think it was in January or so. Yeah, it was in January. I did a video where I talked about Habito, which is the mortgage provider that will basically do 7 times salary. If you've not watched that video, go and watch that video. It's really, really worthwhile seeing what I spoke about there, because what they're essentially doing is they are innovating. They're basically trying to help people get on the property ladder by allowing them to borrow more in their multiples. Now, obviously, there is qualification criteria. So you've got to be in a certain set of key professions and occupations in order to qualify. If you're in the, I'm just going to call them key occupations. Yeah. If you're in the key occupations, you have to be earning 25 grand per annum minimum, okay, to qualify. If you're not in the key occupations, so let me just get this out and let me just go red here. So if you're not in key occupations, then you have to be earning, was it 70 or 75k? It's one of the two. You have to be earning 70 to 75k. But what that basically means is that if you're earning 50k in this example that we were given before, you'll be able to borrow 7 times your salary, which gives you to £350,000. So again, if you go back to the previous equation, right, which is this scenario right here, where you're looking at a house for 250, well, actually, you can borrow more than enough to be able to achieve that property because you're lending 7 times your salary. Now, the set trade-off to this is that Habito wants you to lock in to a fixed rate term, and the minimum term is 10 years, which a lot of people frown at and are like, oh my God, that's absolutely nonsense. Like, why would you want to have a 10-year fixed rate? But actually, why not? Why would you not want a 10-year fixed rate? Oh, we'd die paying the mortgage. Typical mortgages last between 25, 30, sometimes 35 years. And especially if you're young, you're going to have this thing likely for much, much longer. Now, going into a 10-year fixed rate mortgage doesn't mean that you don't have the right to overpay and maybe try to pay off your mortgage early. No, it just means that you get into a mortgage where you know what your monthly payments are going to be for the next 10 years. There are no increases, no nothing. And one of the surprising things about Hibito that jumped out at me when I did that video was there were no early repayment charges whatsoever. Like, which is astonishing to me. You could overpay, no, you could move the mortgage if you wanted to with no penalties at all. So maybe it's something for you to think about, Tamas, potentially as an option. But like I said, the video is there on the channel. I think it was in January when I did it. I'll see if I can find you the upload date so you can just find it a little bit easier. But I definitely encourage you to go and watch it. I think it's likely going to be a more common product set that we'll see moving forward, because you've got to think about where we are in terms of the interest rate cycle. Back in the 70s. So I first spoke about the fact that there are longer term fixed rate mortgages on November 23rd last year. And that was basically saying that we're moving into a territory where we are going to be looking at longer term fixed rate mortgages. The video that I did in January was, where is it? It was on January 7th. 7 times salary mortgage is the thumbnail. So go and watch that and let me know. Hopefully it's going to be useful to you. Just get rid of that. Connor, how do you go about doing your own research? First started investing right before this Ukraine-Russia crisis kicked off and want to spend this uncertain time learning and doing research. Mate, there are lots of research tools that you can use, right? I mean, you've got the likes of Simply Wall Street, right? I mean, they will cut out a lot of the work for you in terms of they'll just tell you what the expense ratios are and all that kind of stuff. But you still need to understand what the expense ratios are. Like, you have to have a foundation in the knowledge of, how do the markets operate? How do share prices actually move? What's likely to impact the share price? What makes a really strong business? When you look at the balance sheet, what does the balance sheet actually tell you? Does it tell you that they're in good shape, or does it tell you they're in bad shape? If they're, paying dividend, for example, how do you know that they've got enough money on the balance sheet to cover the dividend payments moving forward, so that you don't go and buy a company that is paying dividends currently, but the balance sheet is so weak that potentially they have to either reduce their dividends or basically stop their dividends. And because people invest in that company for dividend purposes, once they announce that, the share price then tumbles because people have started to invest in this thing in the first place because they wanted dividends. And guess what? They're no longer paying dividends. There are lots and lots and lots of equations that go about it. You need to get understanding of the fundamentals is really, really important. What I would say is, download something like Simply Wall Street, and have a little play around with what it actually looks like. I mention them specifically because they do cut out a lot of the work. You don't have to work out how to calculate the expense rate, the earnings per share, for example, of a company. They just give you that stat. They will tell you whether they feel it's undervalued or overvalued. At the same time, though, you have to be able to make your own decision based on what they're saying. Tesla is a prime example. Everyone has been saying that Tesla is overvalued for the last 3 years. What keeps happening to the share price? It keeps going up, up, up over the long term. Now, if you had a principle where you only had to look at companies that were undervalue or fair value, you would never invest in a company like Tesla. And therefore, whilst the research tools are important, you have to know how to interpret that information so that you can make the best decision for yourself. So it will be a long process for you, but stick with it, mate. Start to watch like Bloomberg and listen to some of the language and the commentary and find out what those things actually mean, like the terminology means. Use things like Investopedia, right? Investopedia is awesome because you could Google any word on there around asset allocation or quantitative easing. You can type that in and it will give you a definition of what it basically means with an explanation. Try to get to grips with the terminology. I always say that, for people who want to learn about, investing, it's kind of like learning a new language a lot of the time because of the terminology. And it's important to know what the terminology means for context, right? So I always give this example. If you'd never, ever, ever heard French in your life and someone came up to you and went bonjour, you wouldn't know what they meant, right? But if you know that it means hello, you know how to respond. You know what it means, right? The same thing applies when it comes to investing. Understanding the language is really, really important. So you need a foundational knowledge. But people like Simply Wall Street, Investopedia, definitely watch, things like Bloomberg, those kind of things, and read financial media. If you want websites, things like investing.com are really, really good. You can kind of see what's going on and just be inquisitive. It will take time. You're not going to get it overnight, but you start on the journey, you start to build confidence. That's the most important thing, because if you do it now whilst all of this is kicking off, like you're saying, if this lasts for a year or 2 years, you're going to be in a better place in a year or 2 years time than if you did nothing right now. So those are just a few resources. Don't expect to get it right the first time, because you won't, mate. You just won't. And what will likely happen is you'll take on so much information that sometimes the information can be overwhelming. You don't really know what to do with that information. It will come with time, but you just need to be prepared for that. More importantly, you also need to be prepared for the fact that because you may be uncertain around what you're doing and what to do, just be mindful that when you're investing money, you need to take a pragmatic approach with that as well. Don't throw money that you cannot afford to lose into it, because you will make mistakes when you first start. It's just natural. Zazu, how you doing? I like that. Zazu. Good man. Tamas, let's have a look. One more question, P. On which platform is the best to open a lifetime ISA? The lifetime ISA providers they're not that many, they're not that many at all. How many are there? None pop to mind at this point in time. If you Google this, though, you will have a ton of them. I think Moneybox is one that actually has one. I think Hargreaves Lansdown have one as well. Do Wealthify have one? Does Wealthify have one? No, I don't think Wealthify has one. But I'll maybe have a look at. I mean, it depends on how you want to invest. Do you want to go selecting things on your own? If you do, then Hargreaves Lansdown will be really, really good. But if you don't, then you need someone who's going to be able to build that portfolio and manage the portfolio for you, because you don't want to be, second guessing yourself. So, but yeah, lifetime ISA providers they're not that there are a few of them. They're not like there aren't loads of them out there, unfortunately. So yeah, maybe those two. Have a look at Moneybox and Hargreaves Lansdown. I can always rely on Food Dweller for this one. Please reminding people, do smash the like button if you do find value from this stream. There's 25 right now, 54 people watching. All right. Okay. And Andy as well. There we go, guys. Again, if you've not joined my Discord group, the link will be in the description. It's free to basically join. I will be using that more than anything else as kind of like midweek commentary, that kind of thing. More kind of like if we do ever get back into doing, stock analysis, stock research, that kind of stuff, it will be done there and there alone. So yeah, if you've not joined, join. The link's in the description. Yeah, I mean, look, Trevor, I spoke about this, was it last week or so? You cannot use that as an excuse for what's happening right now. It's nonsense, mate. I'm sorry. Regardless of whether or not NATO has expanded further than Russia wanted them to expand, you've got to understand that actually Russia does not have the right to dictate to other countries what level of security they can have. They don't have the right to do that. And whilst I understand that, Russia is concerned about having NATO on their border, NATO has made no aggressive moves towards Russia in any way, shape, or form. Russia is the country who flies jets into UK airspace, into Swedish airspace, sends ships into European waters to test what's going on. So you cannot use that as an excuse for what's happening in Ukraine right now, where actually innocent people, kids, babies, civilians are dying because Russia's pissed off that the NATO has been expanding eastward for years. I mean, what kind of nonsense is that, mate? Like, seriously, that's rhetoric. That's absolute baloney. Absolute baloney. If there had been some aggression, 100% you could say, okay, we can understand that you're trying to defend yourself. He's invaded a sovereign country that bears no threat to him whatsoever. None. Zero. And he's using it as a scapegoat to the world to basically demonstrate his military might. But the reality is, if he ever decided to invade Poland or any of the NATO countries, there will be World War III. So that right there is just nonsense, mate. It's no excuse for what's happening right now. No excuse whatsoever. If Ukraine threatened Russia, yes, I can understand. Self-defense. None of that is actually happening. And I do understand that he feels under threat. But what threat? There has been no threat to him. None whatsoever. No threat to the Russian people. None whatsoever. But he's invading the country right now, and he's killing innocent people, using them as a scapegoat. I mean, the ceasefire today that was agreed, and they've just continued shelling a nuclear facility. I mean, what kind of madness is that? It's like, you cannot say stuff like that to defend what's going on right now. I don't care what side of the fence anybody sits on. At the end of the day, people are suffering, and that's the most important thing here. Let's have a look at this one. What's the bets for the Fed to hike rates by 50 basis points in March? Or is the Fed now way behind the curve? And can this be a soft landing for interest rate hike? You know what? If Jerome does not increase the rates by more than 0.25%, I'll be very, very surprised. In January, he was non-committal. He didn't say, yeah, we're happy to keep it 0.25%. He was very evasive when asked very directly. Now that all of this has happened, now that their last CPI number was over 7%, one of two things are going to happen. If he does increase it by about 0.25%, he will probably increase the number of increments that we're going to see over a period of time, over a 12 or 18-month period. Or he will just be like, listen, these are special circumstances. Looking at all of these numbers, we've got to make an aggressive move. And it might be 0.5%. My fear is, if it goes to that level, you're going to see market reactions. And that's not necessarily going to be a positive thing, particularly with everything that's happening at the moment with Russia and Ukraine, unfortunately. So we'll see what happens on March 16th. I mean, it's very, very close. It's a couple of weeks away, just under a couple of weeks away. Are we on actually to now track the next economic crisis and the next recession now inevitable? Good question, mate. I mean, look, I wish I could say with certainty that we are, but mate, I don't know. I really, really don't know. If you look at what's going on, you can clearly see that it's not good. But markets have been resilient in the past. The big factor is what happens with Russia and what happens from that point of view. I mean, look, we're looking at it, talking about the tragedy of what's happening out there right now, mate. But believe me, people are going to feel the financial pinch here. Trust me, things are going to be painful from a financial point of view. I spent some of the time on the podcast and on here talking about the boring stuff, budgeting, making sure you got emergency funds, all that kind of stuff. It's not sexy. It isn't, but boy, are we going to need that right now. We could very, 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 much be on the verge of an economic crisis and just another massive global recession, but we don't know. I'm half expecting it. And I think sometimes in situations like this, you kind of have to expect the worst because Putin's not going to stop. He wants Zelensky dead. He wants that government dead. He wants to install a puppet regime. He basically wants to cordon off a large part of that country. And this is the other thing as well that people don't quite understand. Ukraine is resource rich, very, very resource rich. If you look at the resources they have, that comes into Russian control with all of the sanctions that have been imposed, is going to have a knock-on effect to the global markets even more and costs even more. So we're at the beginning of what could be a very, very painful time for a lot of people when it comes to just day-to-day living. Like, I don't think people are prepared for what could potentially happen moving forward, and that's the worst. That's the lesser of two evils. I mean, if NATO and the West were to be like, you know what, we've seen enough, we can't have this, we need to, put in a no-fly zone, which they've been adamant that they're not going to do. But if they got pushed and they did, it's a disaster. It's an absolute disaster. Putin knows this. I think that's what he wants. People will speculate that that's what he wants. You go and put a no fly zone in. Well, guess what? You've got to shoot down Russian planes. When you shoot down Russian planes, it's World War III, with the threat of nuclear war. So it's catch-22. You're backed into a corner by a guy who has quite a large military, trying to preserve the way of life that we know and have come accustomed to, with this existential threat at the doorstep. And now we're talking about the markets and how the markets might react. Yes, we could have an economic crisis. We could have a massive recession if this goes the wrong way, which is why you're seeing the likes of Biden and, Ursula, the EU and NATO being very, very, very cautious about escalating this any further, because where it goes is not good if it goes down that route. And it's a job that I definitely would not want to have. I would not want to be making those kind of decisions. And as much as you can watch it on the news and it's infuriating, you feel that something needs to be done. I completely agree that something does need to be done, but at what cost? And that's the catch-22. Decided to move my pensions from my employer's low-risk fund to a global equity index. Does this sound like better play for someone in their early 30s? I mean, yes. I mean, look, if you're, in your early 30s, you're probably going to retire maybe 50, 55, 60. You're going to have, pretty long time to invest. So having it into a fund that is going to make your money work as hard as possible for you, it makes 100% sense, because you do want your money to work as hard as you possibly can for the time that you're going to be working for. No update on trading 212, mate. Not at all. Not one. I did have an update that I need to do. Someone sent me something about free trade last week, which was very, very interesting, around them loaning out pension and ISA assets that are under control with them. I need to look into it a little bit more. But again, it's the same business model that Trading 212 does. And I keep saying they are a low-cost provider. I mean, with them, you pay, what is it, $9.99 for an ISA account or something like that? Or $3.99, something like that, for an ISA account? They need to make money somehow. And if you're accessing a low-cost service like that, you become the product. So they have the ability to sell you on as a product. And that feels like what they're doing right now. Videos to Fu, how you doing? Carly's on here, how you doing? So we'll do this from Kevin. I have a question about, do you think they'll ever stop the 25% tax-free lump sum? Possibly. They could. They would. There are murmurs that they would do that. That would allow them to increase the tax take. So potentially, but it's going to take a brave government to do that. I mean, people have said that kind of stuff is akin to them also stopping the state pension, which at some point they're going to have to do because it's unsustainable, the model right now. And people don't quite understand this. It's really quite fascinating when you actually think about how the current state pension actually works. And when you realize it, you'll understand why people harp on about the fact that you need to be paying into a pension as early as possible. Because guess what? The government cannot afford to keep this going in any way, shape, or form, because it's absolutely ludicrous. It's nuts the way it works currently. I'm just going to clear this so I can illustrate this. And I did explain it on a previous live, and this pad was not working. So now that it is, I'll take the opportunity to draw out what I mean when we talk about the state pension and how it basically works based on the working population and the current tax take. Because ask yourself the question, once I've explained this, whether you want this to ever happen to you, because someone's going to get, I guess, screwed over in some way, shape, or form at some point in time. And it's likely going to be people of my generation who will get to retirement ages before those of you who are in your 20s currently right now. So let me just share this and I'll explain what I mean. Right? So let's just assume, right, that this right here is an ATM. And this ATM is essentially your state pension. Yeah. Now, in order for an ATM to work, you need to have dollars, money being put into the ATM for the money to go out either side, right? So this money that goes in is currently being provided by the working population who pay tax, right? So the money goes in here, and what then happens is the money is being taken out over here by pensioners who were at one point over here. Yeah. So this state pension is being paid for by the working population right now, you and I, who are currently paying tax. And because we now have, evidently, a shortage of workers, right? Because look, social media age, we all want to have our own businesses and be entrepreneurs and all that kind of stuff and do all this, the working population is shrinking. And more importantly, people are living way, way longer on this side. I mean, life expectancy now, 89, 90 years old. Back in the 50s and 60s, when the state pension was actually introduced, life expectancy was probably around about 60, 65. So you retired at maybe 55, 60, you wouldn't have that long in retirement. People are living much, much longer. People are also, talking about, and this is why I always criticize the whole concept of FIRE and the explanations on the function of how they explain that it works, is that if you're retiring at age 55 and you're going to live to age 90 with your life expectancy, that's a lot of years, right? That's 35 years where you're going to be drawing the state pension. And guess what? That money's got to come from the working population, which is dwindling. So with the working population dwindling and people living much, much longer, you cannot sustain this system. It is going to fail at some point. And so what the government is basically saying is, at some point, and this is why they introduce auto enrollment to get you to pay into your pension, and mandating by law that your employer has to pay into your pension on your behalf. They've not done that out of the kindness of their own hearts. They've done that for a reason. They've done it because they know this is not sustainable. But this is the rub. Now imagine you've been in this pool your entire life. Yeah? You've been in this pool of people your entire life. You've got to the point now where actually you're going to go to the front of the ATM to start drawing out your money, and they say, you can't. How are you going to feel? And that's why it's going to take a very, very brave government to cancel this. But I believe it's coming down the line. And many people who work in the pension industry believe that it is coming down the line. When auto enrollment was introduced, 2014, 2015, we were all like, okay. And at the time, Ros Altman was the pensions minister. I was working in Canary Wharf for a pension provider. She came to speak at a number of our events at the time, and she was signposting this back then. It's really, it's a big concern. So if you are, in a pension right now, then yes, putting it into something that is going to work as hard as possible for you is really important, because state pension may not be there. Quite possibly it won't be there, alongside the fact that they may take off that 25% tax-free lump sum, because they might want to increase the tax take in the future. New to London, been 6 months here. I'm on a 5-year skilled work visa, no credit history here. Got 100k for deposit, not seeing financially possible to buy a house anytime soon. Any advice, mate? You need to first and foremost make sure you try and get onto some of the credit reference agencies, like radars. So go and download ClearScore. Go and download ClearScore. Fill in all your details. There are some quick things that you can do straight off the bat. So if you're living in a place right now, you're probably renting, make sure that you are on the electoral roll for the place that you're renting. So make sure you're registered on the electoral roll where you are renting. If you are responsible for the gas, the electric, the bills, make sure they are in your name. If you can get them in your name, those two things will really help you, because one of the key fundamental principles or pillars when it comes to building a credit score is letting the providers know that they can find you should they need to. You've not been here for that long, but the sooner you get on the record, the electoral register, it tells them that you register straight away so that you could be found and tracked. And if you do move, make sure you also put yourself on the electoral register for any new addresses that you basically move to. If you download ClearScore, then what will happen is, it won't happen immediately, but maybe 6 months from now, so you would have been here for a year, they will start to match you to, credit card, credit score builder credit cards, and credit cards that you can use to help build your score. So that's what I would advise first and foremost. Get on the electoral roll. Try and get any bills in your name paid from your account. And yeah, just go and get things like ClearScore and get on the credit reference agencies, so you can start to build your file. And what's the better long-term investment, accumulation ETFs or distribution ETFs? In my opinion, it is accumulation ETFs, because then you're getting the true impacts of compound interest. If you're getting a distribution ETF, they're paying out the profits, so you have to manually reinvest them. And if you forget or leave it for a period of time, then potentially you're not getting the full benefit of compound interest. So for me, if you're looking for long-term growth, accumulation is, in my opinion, the best way to go. Should you join Jim Cramer's investment group? If you want to, mate. If you want to, I don't follow him. I do follow him, but I'm not part of his group. But if you want to, by all means. Paragon Bank. Okay, they have a cash lifetime ISA. Okay, 0.5%. That's not actually bad. I think Moneybox have a good one as well. I think theirs might be something like 0.7 or 0.8. I think. I'm not sure. You might have to check that out. I've now caught up to the Russia comments and Putin. It's mad, It's just, to think this is happening in 2022. It's nuts. It's crazy. Okay, someone's saying that Trading 212 are now open. They sent you a link via an email to open an account, and I was on their waiting list. Hope that helps. Good man. Okay, that's good to know. Yes, guys, if you've not hit the like button just yet, please make sure that you do. There is a super chat on here as well, so let me just get to that, because that's further down the posts. Let's have a look at this. Thank you for this, by the way. It really does help. Might be a little in amount, but it really does help. Hey, Pete, I know this is off topic, but do you know about the tax for Forex traders in the UK? Tax for Forex traders on the UK. I'm not a tax expert, but it's trading activity. So most trading activity will be subject to it can be subject to both capital gains and income tax, but I'm leaning more towards capital gains tax because the fundamental principles will be the same as, I guess, crypto. The crypto taxation rules will be very, very akin to the forex. That's my understanding of it. I could be wrong though, but I would imagine that it's going to be capital gains tax and maybe income tax if you're taking a regular income from it. You'd have to check with a tax expert if I'm completely honest. There are some videos on the channel uh, where we talk to an accountant about taxation. It was more about crypto specifically, but I think there'll be some key takeaways from that conversation that you will find useful. The last one that I did was with a guy called Chris Etherington. We did that on the when was it? When was it? Sorry, I'm just looking through the channel. Yes, if you go to the video on the February 22nd, that video would be helpful, I guess. And yeah, maybe have a chat with Chris. He's really, really good. He's very, very good, and he's from a professional accountancy firm here in the UK as well. Okay. Look, this isn't a political channel, right? So obviously, we've spoken a little bit about politics today and all that, right? Politics has a huge impact on the stock market. That's the only reason why I have a conversation about politics in relation to the stock market. But this is not a political channel. So yes, the US is a bully. They've been the cause of wars worldwide, especially developing countries. Russia making a good stand. Look at Libya. Russia is at no threat from the US. They have nuclear weapons. There is no US president that is going to be stupid enough to attack Russia or to threaten Russia. If anything, Russia's been the aggressor in trying to destabilize their politics. That doesn't mean to say that the US doesn't have really messed up foreign policies. Absolutely, they do. Absolutely, they do. And to a certain extent, they do try to run the roost and fly this flag of virtue, which they tarnish at every opportunity they get to in foreign policy that benefit their country, their economy, their stock market that we talk about here on this channel as an investment vehicle. I'm not saying that those things aren't right, but none of this justifies what Russia is doing right now. And if you think that it does, then in my opinion, you need to basically take a really hard look at yourself, because in any war, nothing that is happening is justified. Doesn't matter whether that's in Ukraine, whether that's in Iraq or Afghanistan or anywhere in the world. It is not, it's just not justifiable. It just isn't. And you can say that Russia is taking a stand. Nobody is threatening Russia. Not one person is threatening Russia. Nobody is being an aggressor to Russia. And so you can't justify those kind of statements with this kind of these kind of circumstances and what's happening with those kind of comments. Yes, I get the virtual signaling from the US and that dynamic, and the fact that they need to be stood up to. I can completely and utterly take that on board, 100%, right? And the reality is, the shape of the world is going to change. China. Just look at the rise of China. The one big difference that we see, in my opinion, is the fact that you have the Western world, which is democratic, and what feels like this, I guess, tension between other countries that carry a different sensibility when it comes to how they run their countries in terms of communism, right? And you can we can start debating the pros and cons of communism and pros and cons of democracies all day until we're blue in the face. It's irrelevant to this channel, which I wouldn't go into that kind of conversation. But speaking specifically about China, the shape of the world is changing. China is going to be the largest economy in the world come the next maybe even 5 years, if not sooner than that. But certainly in the next decade, they will overtake the United States. They've done that without firing a shot. Honestly, they have. And we can start talking about, well, will America basically just sit there and take it? Probably not. So what's going to happen? But even if we find ourselves in this position 5 years down the line from now, and there's a war that America kicks off because, oh, guess what? We don't want China to overtake from an economic point of view. You'll find me saying exactly the same thing. In war, none of this stuff is actually justified. It really, really isn't. The Fed creating its own stable coin. This is the stable coin, right? They're talking about. It'll be interesting. I mean, look, I think it's going to be years off. They're not going to be able to create that overnight or anytime quickly. They're definitely not. Like central banks are notoriously very, 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 very slow on developing this kind of stuff. I think it will change the way money works. I mean, look at the sanctions and look at what's happening with Bitcoin right now. I mean, I looked at Bitcoin on Friday. Bitcoin was at 55. Actually, let me just have a look at it right now because Bitcoin was back at 55,000 when I looked at it on Friday. And thankfully, because I'm holding quite a bit of Bitcoin right now and seeing it down for the last, it feels like month, has been extremely painful to see that it's actually rebounded slightly, or did rebound slightly, albeit it might be temporarily, is good. But, we talk about renewable energy and the fact that, in hindsight, we should have done more. Now, things like this really highlights the need for DeFi applications, having a banking system which is not centralized or controlled by a central bank. This further proves that case. eToro is down for scheduled maintenance, so I can't look at my Bitcoin holdings right now. But yeah, last time I checked, Bitcoin was like 55. What was it? $55,000. Let me see if I can have a look at it on invest.com. Investing.com. Go on to one of the crypto sites as well. Cryptocurrencies. Where are we? There we go. What's Bitcoin doing right now? 39,000. All right. There we go. It's always going to be volatile, though. We know that. So it's one of those things, right? But there we go. Naeem, how you doing? Thanks for lifetime nice video. Moneybox might introducing ETF funds. I heard on Aaron Knightley's channel. I'm surprised that they don't have ETFs already. I'm sure that they have ETFs already because Moneybox build like investment propositions, and I'm sure they have ETFs in them already. I don't think it would be a new thing. I'll be very, very surprised if they weren't already using them, unless they're saying they're going to launch ETF specific, but it still doesn't make any sense. They would have ETFs in their existing proposition anyway. So, okay. There's lots of Russia comments here, and is it good to invest in banks located in Canada? Mate, I could not tell you. Just like any other company you would buy, it's fundamentals. You have to do the fundamental research and find out about the actual bank as a business, and if there's any systemic risk at all to them as a business within Canada and that Northern American territory. So I wouldn't be able to tell you, mate. I don't know any Canadian banks to be able to give you any kind of like overview of what they're like. This is a really good comment, by the way. And when you're talking about Libya, that's why. And I kind of alluded to this, with China potentially being the new dominant economic power in the world in the next decade or so. Will America try to do to China what they did to Libya? The answer to that is hell no, because China is absolutely huge. They are miles ahead of most people, a lot of countries, technologically wise. I mean, just from a technology point of view, they're miles ahead. Didn't they test like a supersonic missile or something like that? And the Americans are scratching their heads like, we have no idea how they did this. Trust me. Like, the Americans cannot do what they did to Libya to people like China, for example. And the whole reason why Libya happened was because of the fact that there was this theory that Gaddafi was developing something that would replace the US dollar as the world as a global currency, and they can't have that because of that. So hold up, nah. I thought United Food Dweller, stop it. I thought United and City were playing tomorrow. Are they playing tonight? Or are you just predicting the scores? That's a goal prediction, right? I'm sure they're playing tomorrow. I'm pretty sure they're playing tomorrow. I hope it is 2-1. If it is, I mean, I don't. Who knows? Who's going to turn up? I think he's dropped Ronaldo tomorrow. So who's going to be up front? Is it going to be Cavani? I have no idea how that's going to be, how that's going to shape up, but we'll see. Anyway, no, I see where the comment actually came from. Nice one, Kevin. You know what? It could be anything. As long as the performance isn't as bad as the last time, where they basically we were like school kids, like playing against adults. As long as they actually put their back into it and they actually play like a team and attack and create chances, I'll be happy. I'm not expecting a win tomorrow, if I'm honest. Not expecting a win at all. I've got a few friends who support City, so I'm sure that they'll be rubbing it in at a City victory. I hope it's a draw. If we can nick a win, fantastic. As long as we don't play like school children, then I'd be happy. But I have very, very low expectations. What should we be looking forward to next week? And when is your Channel 4 program going to air? Thanks for reading. What should we be looking forward to next week? I mean, next week, I don't know what's on the calendar from a financial point of view next week. I mean, in terms of content, mate, to be honest, my schedule's so crazy that, to be honest, there hasn't been a lot of. I haven't put the amount of research that I normally put into videos because my schedule is just so crazy. I mean, as an example, next week, so tomorrow night, I go to London because I've got to record a brand podcast on Monday morning in London. Then from there, I'm going to leave to go over to Cardiff because we're shooting for 2 days in Cardiff. And then we were supposed to be shooting in Mansfield Thursday, Friday. So all of next week, I'm completely out. And because it's quite intensive in terms of the filming schedule, what we're doing, and I have to prepare and all that kind of stuff. And I've still got to record the podcast and record the videos and edit the videos and edit the podcast. I've got a ton of stuff that I need to do. I've got to prepare for the podcast recording on Monday for the brand. There's a lot going on. So I've not put a lot of research into a lot of the amount of research that I would normally do into video topics, that kind of stuff. So I've got a couple of ideas for what will come out next week. There is one video that's already pre-shot. It's, some tips around how to be a better investor. I don't know whether that will come out on Tuesday or on Friday. It depends how I get on tomorrow with my workload. So yeah, the videos will be there next week. I just won't be able to do any live sessions midweek unless I do it on the fly whilst I'm out and about. But I'm probably not going to have time to do that during the day. And in terms of when the program is going to be airing, I'm told it's going to be in April on Channel 4. But yeah, I mean, it was supposed to be airing in March, but it's been pushed back a little bit because we're still capturing footage and filming and stuff. So yeah, mate. Thanks for the interest, though, pal. Really do appreciate it, Naeem. My thoughts on Chamath and Virgin Galactic. I like Chamath. I think like that guy. He's quite. I mean, it's just my opinion. He's quite down to earth. I like him. He speaks his mind. He's really really impressive, and he's very very knowledgeable in what he does. I do listen to his commentary, and I do pay attention to what he says because I just think he's a solid guy, really, and he's quite knowledgeable. And I've watched a couple of videos where he's talking about Tesla, where he will praise Tesla, and someone asked him once, said, "Do you still hold Tesla?" And he was like, "No, I sold it all." And he was like, "Why?" And he was like, "Well, unfortunately, I have other things that I want to invest in. And so sometimes I have to cash in where I've made profit to invest elsewhere. I don't have a bottomless pit of cash available. So I think it's a great business, but I no longer hold those shares. I wish that I did, but I don't." And he's quite honest with that. Virgin Galactic, I haven't followed anything with him and Virgin Galactic specifically. I know that Virgin Galactic had issues and stuff like that. Virgin Galactic can be very, very exciting. I think they need to sort out their whole commercial proposition. I mean, I hold a little bit of Virgin Galactic in stock, and it's done okay. But once we have more clarity on what their commercial package is going to be, and they've ironed out some of their kinks, I think they'll be okay. But I do like Chamath, but I don't know if there's any drama between the two of them. This is a good question. I answered this actually in my Discord group this week, which, with the economy and the political scene as it is right now, is there any sectors or industries you have switched to gain better performance in your portfolio? I haven't switched anything. So my portfolio is set the way it's set. Like I said, I invest as a core satellite approach. I don't need to do anything. My portfolio is diversified across sectors. If I were to tweak anything, I would tweak things in my individual stocks. Most of my individual stocks, a lot of it I sold down in January before all of this kicked off. So, in terms of sectors that I think would do well, I think energy will do well over the next 12 months, 24 months. I think energy would do well. If I had to switch to move to anything, I'd probably move towards inflationary protected stocks if I was picking individual stocks myself. But for the bulk of my money, I'm doing nothing at all because I don't need to. It's all either in a diversified ETF index fund proposition that's built, and I've got money in managed propositions as well, where companies are actually just doing what they need to do on my behalf to make sure that I'm getting the best out of the situation right now. And it's all well and good watching YouTube and enjoying the journey of learning and stuff, but this really is, especially in times like this, it's really, really important that you know what you're doing. Like, I'm not going to sit here and say, yeah, I'm switching to this and that just to make myself sound good. No. A lot of my money is in funds where I don't have to worry about anything. I'm not changing anything for the bulk of my money that's invested. I'm not doing a thing. I'm not buying. I'm not selling. I'm holding. My individual stock portfolio that I sold down at the beginning of this year, I actually made a video where I explained why I'm looking to do that and why I took that decision. I didn't know that all of this stuff was going to kick off. I had no idea. But now that it has, I'm glad that I did, because I've got some money set aside that if I did want to go back into the market, I can, if I want to. But thinking about my goals and where I want to be in the next 18 months, I need cash. If the markets crash, I cannot afford to put off my 18 months until markets come back around. And these are fundamental principles that I talk about all the time. That is boring, right? It's not sexy, but this is real stuff. This is really, really important stuff. And for me, that's how I like to invest. It's not for everybody. Some people want the highest returns possible. In that case, they can go and watch the hype videos. For people who want a sensible approach, that's what I do. I take a sensible approach. And my position in life is very, very different to a lot of people. I'm not desperate to buy property. I'm not particularly fussed about making a shed load of money. I'm pretty okay. So my outlook is very, very different. I'm aware of that. And I know that that is a position of privilege as well. So my outlook isn't going to suit everybody. But at the moment, I'm doing nothing. I'm not changing anything. I'm not switching. I'm not doing anything. My money is set as it is. And I'm just going to ride it out. I'm going to hold. With the Russia sanctions because of their invasion of Ukraine, it got me thinking about how that kind of sanction on China, if they invaded Taiwan, wouldn't work. Like everything is, yeah, mate. Listen, this is what I'm saying, and trust me, China's going to be watching what's going on right now with interest, because if the West does nothing, that's going to give them the green light to be like, you know what, Taiwan, we'll take you back, we'll invade, we'll control that territory again. And trust me, the US want none of that. They don't want that smoke. They don't. The amount of debt that China has, US debt that China has, they don't want any of that. And so this is why what's happening right now is such a big deal. It's such a big deal. But like I said, I'm not a politician. I'm not making those kind of decisions. Neither nor would I want to make those kind of decisions, because these are big, big, big decisions. And it doesn't matter how we got here. We're here now. The genie is out of the bottle. What is really important is, how do we learn from this? Because in 2022, we shouldn't find ourselves in this kind of conflict. We just shouldn't. It's 2022, for goodness sake. Like, seriously? It's mad. It's absolutely mad. I hope so. I hope United absolutely surprise City tomorrow. And you know what? I actually hope that Sancho like shines. I hope he does really, really well on the pitch and causes them all kinds of trouble. I hope he gets a goal. I hope he gets an assist. I hope he does. But who knows? I like this. Yeah, I wouldn't be surprised if City are the bookies' favorite to win. I mean, look, them and Liverpool have been incredible this season so far. So yeah. Every consumer shopping these days using buy now, pay later. Is there a bubble in buy now, pay later model given by the outcome of the Amigo loans? Yes, there is. It's, mate, listen, the whole buy now, pay later thing is literally, it's an endemic. Like, it's so common now, and the thing is, it's fiscally and financially irresponsible. People think that because there's no interest on it, I'll pay for it later on. And this is what happens, right? People then get into this habit where they buy everything on it, and it's only £2 here, £5 there, £10 here, £3 there, but that all then adds up, and it's money that you owe. Fundamentally, you're buying something that you cannot afford to buy. If you want to buy something, buy it because you can afford to buy it. It makes this whole consumerism thing more accessible, more contagious, and it's not healthy. It just really, really isn't. And when you look at the likes of people like Monzo, for example, now bringing, having a business line with that, I don't like it. I don't like it at all. It does not teach people about responsible financial sense. It just doesn't. It's not good. It's not good. So electro well done. Council tax on my name. Electricity, water not in my control. Building provides. Triant logbox. Yep, they are good. I've not looked at them specifically for a review, but I know that they are good. I know people who have reviewed them, who have used them. So yes, they are very, very good. That's a good start. Now, mate, all you need to do now is just give it another 6 months or so. Get ClearScore, because all that information will be fed into the credit reference agencies. And once ClearScore gets that data, so ClearScore will update your profile, your file every month or so. One video that you could go and watch, mate. I did a video specifically on credit scores, and there were 11 key factors, I think it was, that I highlighted for you. It was the video on the where is it? Yeah, so boost your credit, 11 factors. I actually walked through ClearScore using my credit score as an example. So that video was on the 15th of Feb. So about 2-3 weeks ago. Go and watch that video, mate. That will really, really help, because I actually talk through how they actually match you to offers that will work for you based on your score. So you've got a higher chance of actually getting accepted for something like a credit score builder credit card or something like that. So that's good to know, mate. Well done. Yeah, I've done this a number of times, but let's do it one more time. Let me just clear this pad 1 second because I've still got the doodles from the last one on here. Okay, so I know I get really, really like passionate when I talk about this kind of stuff, but the thing is, mate, like people have been investing based on vibes for what feels like for ages now. And it's just the wrong thing. And like, I don't know, mate. Maybe I talk about, obviously I've worked in the industry for such a long time, and sometimes when I say that, I feel as though I'm blowing my own trumpet, and I feel like sometimes it comes across as though I'm trying to qualify myself to be like, guys, you should listen to everything I say. That's not what I'm saying. I only reference that because I have been with people who have gone through a market crash, and I have seen the impact of what that basically means when people get it wrong or they don't account for things. Sitting down with a couple who are in retirement taking an income, the market crashes and you're having to tell them, by the way, I'm really, really sorry that this has happened, but you can no longer afford to take the same level of income you're taking. Actually, in order for you to make sure that you don't run out of money, you need to half your income. I have been in rooms like that. Most of the people on YouTube who are making all of these videos about this hype stock, invest, blah, 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 they've never been around any of that stuff ever. I have. And when I talk about this stuff, I get really, really passionate about it because I actually care and I see the impacts. If you get it wrong, it can be very, very painful. And that's not wishing that anybody gets it wrong. But if you're told these things and you're able to take it on board, maybe, just maybe, it's going to make a difference. Just maybe. And I know it's not sexy. I know it's not. I know it's not, you're going to be rich and be a millionaire and you're going to make a load of money quickly, but it is fundamental stuff that matters. Like people pay thousands of pounds to take exams and go through very, very painful regulatory frameworks to be able to do the job that I did. And there's a reason why they're not on YouTube. Because guess what? They need to make money, and YouTube isn't where you make money. Like financial advisors, I know financial advisors who bring in 2, 3, 4, 500,000. I worked in a practice for a woman who made $1 million a year. She has no business, no desire to be here on YouTube. She makes so much money off her clients. This is peanuts to her. Literally. I say this stuff because it's really important. I wanted someone to tell me this stuff when I was 25 years old, to give me the basics when I was 25 years old and not blow smoke up my ass to get me hyped to invest vibes, right? It's really, really important stuff, guys. So anyway, satellite core approach. Let me just get this right. All right. So this is your core approach here. Okay. And in this core approach, you are going to have your index funds, you're going to have your ETFs, your multi-asset funds, whatever the vehicle may be. But essentially, these are funds, okay? And a fund is essentially an investment vehicle that is built with diversification, with across sectors, across geographical regions. It is built to stand the test of market volatility, market fluctuations, and can either be an active or passive strategy. If it is a passive, it will track the markets, it will mirror the markets. So if the markets are going up, you'll see that reflected. If the markets are going down or up and down, you're going to see that impacted. If it's active, then it means that when the markets are going down, somebody is going to intervene to try and move the portfolio into a more favorable strategy or approach where you can get some profit out of what's going on right now. Okay. That's your core. Your satellites are a number of stocks or companies, and you could have 20, you could have 50, you could have 100, however many you want, 40, 60, 80, right? And these are companies that you hold: Tesla, Amazon, Google, which is Alphabet, Facebook, Meta. You could have Coca-Cola in here. You could have Target. You could have BP. You could have JP Morgan and Chase. You could have HSBC. You might have, I don't know, AT&T, right? These are your individual stocks. The majority of your money sits here. So it could be 60 to 90% of your money sits here. The remainder sits in these companies. That's your core satellite approach. And the idea is the bulk of your money is saturated, diversified across the global markets, with you taking a particular interest in a certain number of companies that you want to have exposure to. Now, what I've done, most of my money's in here. I'm leaving this as it is. I've made changes with these companies in my own strategy because where I want to be in 18 months requires me to need cash. And I'm not going to jeopardize where I want to be in 18 months for the greed of, oh my God, the markets might make me another 10%, but then the markets crash. I've got to wait 5 years for the markets to recover potentially, and I can't achieve my goal in 18 months. Like, people forget that it's not about the investment return, it's about your goal, which is why it's always very, very personal. And I harp on about goals all the time. If people think I'm boring, but it dictates everything that you do. There is no point in you investing money if the purpose for which you invest in it, you can't use it for that purpose. Why did you do it in the first place? So for me, that's core satellite approach. I have tweaked all of my individual stocks. I've sold a lot of them down. Still hold some, but I've sold a lot of them down because I need cash for 18 months. So that's core satellite approach in a nutshell. All right. There's lots of. I'll see how many more of these I can get through. I've still got some work I need to do tonight. I've been researching to start investing now, but given what's happening, I'm having second thoughts. Do you think I should wait or carry on as planned? If you're looking to pick your own stocks and you don't know what you're doing, don't pick your own stocks in times like this. You're better off going with someone like literally Wealthify or any other provider that will manage the investment for you. If you're trying to pick it yourself, you could get it wrong. And if you get it wrong in times like this, you've got to be happy with the fact that you potentially lose money. It might take a little bit of time for you to recover, or you'll simply just panic and you've lost the money. Trust me, I coached a lot of people last year and I've told them, one springs to mind specifically. Guy had a session with me, had about 30, 40 grand. I want to put all this money into Tesla. This was when Tesla was probably around about $700 just after the split, right? I said to him, look, give me the rundown of your situation. You got a wife, you got a baby. Are you sure? Why do you want to pick Tesla? What do you like about Tesla? What do you understand about the risks when it comes to Tesla? He said, I'm happy to put money in. Okay, you need to hold some money back because if everything drops, you don't want to be destitute, not be able to feed your wife and your kid. He held some money back. But nevertheless, he put a large chunk of money in. And he texted me when he did it. And I went, good luck, mate. I tried to put him off as much as possible, but also tried to be fair to let him know, look, this is Tesla's volatile. It's very volatile. You can put it in right now. It's going to go up 10% tomorrow. Then next week, it's down 8%. Like, it's so volatile. And you have to understand this about the market, especially if you're trying to pick your own stocks. For him, he put the money in, messaged me about 2.5 weeks later on. He pulled it out because he panicked when the market basically tanked. He lost about 3-4 grand. And all the time he was telling me, I'm cool. It's okay if it goes down. People say that a lot. But when you have it in your investment account and you're seeing minus X amount, whether that be hundreds or thousands, trust me, you think twice, because the overwhelming fear that you feel is, what if it continues going down? If it continues going down, I'm going to lose all this money, and that's where people panic. So if you're researching to start and you're picking your own stocks, don't try and pick a provider who can help you. It doesn't mean that you're not going to have the bumpy ride. You will still have a bumpy ride, but at least you know you've got a team of people actually who are qualified, who studied, who have got degrees, who are being held accountable to the decisions that they're making in your best interest. At least you can sleep at night knowing that you've got that. That's what I would suggest. But again, it's not my money. It's not my decision to make. It is completely down to you. But that's honestly what I think. It's not boring. It might not be what you want to hear, but this is not a joke. People who have invested over the last 24 months who thought all of this was rosy, I get messages all the time. I had one last week. I've lost money and I'm really, really kicking myself now. I didn't think it was going to be like this. It happens all the time. Would your investment strategy be different from mine, for i.e., because you're in your 40s and I'm in my 20s? Potentially, yes, because your time horizon is going to be different to mine. But then it will just be about what you invest in. So in your core approach, are you invested in more aggressive, more, I don't know, adventurous kind of like funds and ETFs? That may be the main difference that you would have. And particularly in your stock selection in your satellite, you might be looking at pure growth stocks in opposed to having some value, some foundationary, solid companies to give you, stability within your individual stock portfolio around your core. So yeah, it could be different depending on obviously what your goals are. Madiba, thank you, mate. No, appreciate it. I'm going to call this to a close in a moment. There are quite a few comments. I'm going to try and power through them. Where was I? Here we are. CFA or FINRA? I don't know whether there was a prior comment for this, mate. Yeah, I don't know if there's a prior comment for that, so I don't know what the question is. Okay, let's have a look at this one. Thanks for the insight and wisdom. What advice for an oldie who has just started with little in pension and savings, hoping to invest and save for the next 10 to 15 years as a minimum? So, depending on how old you are, I mean, you say oldie, people will say 40s old, which means I'm old. I don't know how old you are, mate, but because you're going to be closer to your retirement date, I kind of mentioned this last week or on the last live or one of the lives of the past couple of weeks. Let me just clear my whiteboard again, and I'll just explain what I mean here, just to give you a visual reference to it, because this conversation and these kind of topics can be quite in depth, but they are important conversations to be had, because what you basically need, because you have a shorter, well, maybe not shorter, but you have your goal means more because of where you are in life right now. It's really important that you think of some of the real key basics that go along with it. So, let me just find, right, we know we are. Okay, cool. So I'm going to assume, let's just say you are in your 50s right now, okay? And I'm going to assume that you said, what did you say? Okay, 10 to 15 years. So 10 to 15 years will take you towards 60, 65, okay? Making these numbers up under an assumption, okay? Now, you've only got one shot at this. You're not in your 30s where, you've got time to catch up. Because you got 15 years, one of your biggest concerns, I would guess, will be the monetary amount here that you can use for an income, right? That's what I'm assuming, because that's what most people that I've worked with through my career have been concerned about at this stage when they ask these kind of questions. So they're concerned about this income number. So the important thing here is the ability to be able to forward think to the, let's get red here, to forward think and forward plan to this number so that we have a set number or an idea of a set number in mind. Now, let's just say, for example, it's £20,000. And this is assuming mortgage is paid off. All you've got to do is pay gas, electric, council tax, food, and just general lifestyle stuff, right? You need 20K a year. The next thing you need to do is be able to back plan from this point onwards what you need to do to get to this point. Okay. So it's pragmatic, systematic planning. Now, what we try to do is obviously ascertain, right, how much money needs to go into this pot to get to this point, but also trying to work out, right, for a lot of people, these numbers will shock them because it's like 20 grand a year. If you look at the actual size of the pot you need, it could be huge. And then these numbers actually look huge. But then we try to break it down a little bit. Okay, so state pension, how much does state pension actually bring in? If you're a single person, state pension will probably be about 9 grand per year, right? If you're married, you can times that by 2. That's going to give you 18K, which means that actually if your income requirement is 20K, you haven't really got to get a lot. All you need is an extra £2,000 per annum. But the important thing is you have to know what this number is. And you probably need help to try and visualize, forecast what that might look like. Obviously, during this period of time, the big risk that you're going to face is inflation. Because 20K today is not 20K in 10 to 15 years' time when you retire. So your contributions into this pot to get you to this point have to reflect the impacts of inflation, which will basically inform your investment vehicle and how you're investing into the market itself. So there are some really, really key considerations here. And what I would say is, look, financial advisors often get a bad rap. And trust me, I know that they do. Some of it is deserved, but there are a lot of really, really good ones out there. If you don't know how to work this out yourself, then you should go and see a financial advisor. A lot of them will not charge you to see you right off the bat. The initial consultations are completely free. You only pay them if they implement something for you. But the benefit of it is you will at least get to know what you need to do to make sure you can get to whatever this number is with a high level of, I wouldn't say certainty because certainty is the wrong word to use. But what they do is they will say, right, okay, within the investment proposition, which will take into consideration inflation, we will work out and say, right, so what if there is a market crash? What if the market does well? And what if the market does great? Right? And then what they do is they take these scenarios and they stress test it. So by the time you've had a conversation with them and they present a plan for you, you will know what you're potentially going to be, if it crashes, if it goes well, if it grows great, and you'll also know what your middle ground is as well. So that's what I would suggest. But the first thing is make sure that you're paying into a pension of some kind. So provide a selection if you haven't already got one, but please see a financial advisor. If you don't know how to get one, just message me on Instagram, Conversation of Money, or you can email me at pete@conversationofmoney.com, and I may be able to introduce you to one or two that I know who are really, really, really good guys. But that's what I would suggest because this bit is so important. You cannot afford to get that wrong because of where you are right now. Quite an in-depth, maybe a boring answer, but if you were my client, if I was your financial advisor, this is what I would be looking at. This is the work that we would be doing to make sure we can really flesh out a strategy to get you where you need to be. All right. Okay. Yeah, I mean, I would agree with this one. When I first looked to invest in stuff, I'm glad I was able to see the sense, the too good to be trueness, and those kind of videos. I don't believe those who get sucked into them. It's sad, really. I mean, the thing is, unfortunately, people do get sucked into it, and I don't know, mate. It is quite sad. But that's the reality of the world, mate. Unfortunately, people are too caught up. And again, maybe it's just because I'm a little older now and I'm in a better position than I was maybe 10 years ago. I could definitely appreciate that if 10 years ago I was in the same situation right now, my mindset was very very different. But that's what experience does. It gives you hindsight, right? It gives you the benefit of hindsight. I can't necessarily blame people, and when I try and talk sense, I can see why it isn't attractive to people. But at the same time, I want to attract people who want to know the basics, who want to know the good stuff. I don't, maybe I just don't know how to cut through to, I don't know, maybe meet people in the middle. But at the same time, I don't want to make content that I don't feel necessarily comfortable with. I don't know. It's a really really weird one, but I know this kind of stuff does happen. It happens all the time. I didn't notice that, mate. I did not notice that at all. Good man. Um, Thank you, mate. Try to make these as valuable as possible, to be fair. And I appreciate the fact that the numbers are still quite constant all the way through this. So, yeah, thank you guys for being here. Um, how is your managed portfolio doing in this time as compared to your ETF and index fund? Um, you know what? I've not actually had a look at the other LNG funds that I've actually got versus the managed one just yet. I've not done a comparison. I normally have a look twice a year, so I would look at it until probably May, June or so. I've not had a look, but the last time I checked, it was still doing really, really well. I mean, my LNG one is invested in Future World Technologies. That's done really freaking well, like really, really well. So yeah, but I've not had a comparison of the two of them because it's not time for me to have a look just yet. Qualification in finance, what's better? Um, it depends on what you do because there are different qualifications based on what you want to do. So, for example, if you wanted to be an investment manager, then you're doing the CISI. If you want to be a financial advisor, then you're doing things like DIP-FA, diploma level 4. You're doing the level 6 kind of thing. If you want to be a mortgage advisor, you're doing CMAP. It depends on what you want to do. So the qualifications will be dictated by the role that you want to basically go into. All right, guys. I think I'll come. Look, so mate, listen, you're the same age as me. Then you're the same age as me. So you're 43. I'm 43. So we'll have a lot of common themes in mind there. I mean, look, when it comes to the investment time horizon, you probably got time actually, to be fair, and having a clear idea of what the income amount is going to be and assets that you're going to accumulate over that period of time are absolutely crucial. But contributions into your pension are primary, like really, really primary. Truth is, you'll probably have to be a little bit more aggressive in terms of your contributions. If you're employed, then you should absolutely be making sure that you've got an employer that matches your contributions so you can get as much free money out of them as possible. So if you're not in the workplace pension scheme already with the auto enrollment, you need to be. And if you're high level in a business, things like salary sacrifices, that kind of stuff will massively, massively help you. If you're running your own business, then, turnover and trying to maximize profitability is going to be really important because one great thing that business owners can do is if you have a load of profit in your business, your annual allowance for your pension is 40K a year. But most people don't know that if you run your own business and you've got a load of cash sat in your business, what you can do is you can go back 3 years and contribute 40K for 3 years. So in other words, 40 times 3, 120k. You put that one lump into your pension pot. That's an allowable expense that reduces your corporation tax. Mate, there are so many things that you can do, but it really depends on your circumstances. So yeah. All right, guys. Thank you so much for being here. Yeah, there's been a good number of you. Thank you. Like I said, would have loved to have done this tomorrow, but this time tomorrow I'm going to be literally either on the road to London, and then yeah, next week is going to be absolutely nuts. So yeah, appreciate you guys. If you're not joined the Discord group, please go and join the Discord group. It is pinned in the description to this video. So have a great weekend. I will catch you later on. Cheers, guys.